Have you ever felt like the big players on Wall Street have this massive unfair advantage when it comes to investing?
Yeah, like they're playing a totally different game,
Yeah,
with tools and info you just can't get.
exactly. But what if we told you that you, the ordinary investor with a bit of common sense and, a willingness to do some homework?
You could actually outperform those so-called experts.
Precisely. It's a powerful idea, right? That maybe your everyday life gives you an edge.
An edge that even the most sophisticated funds might lack. It kind of flips the whole script on who can win in the market.
Totally. And that's exactly what we're diving into today. We're doing a deep dive into the timeless wisdom of Peter Lynch, one of the greats.
I mean, managing Fidelity's Magellan Fund to, what was it, a 29.2% annual return? For 13 years. That's just staggering. Consistently doubling the S&P 500.
And his book, One Up on Wall Street, it's legendary. But this isn't just history. We think his ideas are incredibly relevant for you right now.
Absolutely. His principles aren't just about his past success. They're profoundly useful today for anyone trying to, navigate the market with more confidence. Spot those opportunities Wall Street overlooks.
So our mission today is pretty clear. Unpack Peter Lynch's core lessons, distill his actionable advice, and help you see how to apply these strategies, finding those overlooked gems, navigating the noise.
All without getting totally bogged down by information overload, which is easy to do these days.
Okay, let's jump in. Let's start with maybe his most radical and honestly empowering idea.
The idea that you have an advantage.
Yeah. So Lynch really believed that ordinary folks, people like you and me, often see trends before the market experts. Why? Because the best investments might be in companies you interact with every single day.
Like, think about those fast-moving consumer goods, FMCG, your coffee, your toothpaste.
Or even the software your company uses, or that co-working space down the street. You're living amongst these businesses. You see what works, what doesn't.
Right. You're experiencing their products, their services firsthand. But, okay, here's the pushback you always hear.
How can I compete with some billion-dollar hedge fund using satellite photos of parking lots?
Exactly. They seem to have this, insurmountable information advantage. How do you beat that?
And Lynch had a brilliant answer. He basically said, yeah, that high-tech stuff has limits. What about the stores inside the mall?
Good point. A satellite can't see that.
An analyst sitting in New York, they probably have no clue about the real foot traffic in some specific mall store in, say, Ohio. But a local customer or an employee, they know.
That's your edge, that local on-the-ground insight.
Even Lynch himself, he admitted he didn't really play the dot-com boom in the 90s. Said he couldn't understand it without his wife or kids explaining it.
He stuck to what he knew, which is the core message, isn't it?
Invest in what you know. It's more than a catchy phrase. It's strategic. Your daily life is like constant market research if you pay attention.
Yeah, think about your workplace. The insights you get there about essential products or services, stuff businesses need to run.
Like someone in the food industry noticing a particular snack is just flying off the shelves. Or maybe you work in tech and understand why, say, Spotify has a better mousetrap than a competitor.
Those are insights developed over time through actual experience, way deeper than just reading an analyst report.
So where do you find these ideas? It's actually exciting because you start super close to home. Literally, check your bank and credit card statement.
Where are you already spending your money? You already know those products.
Talk to your friends, your family. Lynch apparently got tons of ideas just listening to what his wife and kids were into.
Simple, but effective.
Or take a trip to the mall. Seriously. Lynch pointed out that customers in, I think it was Central Ohio, saw KFC's potential way before Wall Street did, just by seeing the crowds.
Because they were there.
Yeah.
They saw the lines. Wall Street, maybe not so much.
These are places you can find ideas the big institutions stuck in their towers might completely miss.
It's a powerful starting point. Finding those initial sparks.
Okay, so that's how you find ideas.
Yeah.
But, and this is a huge but from Lynch, simply liking a product or having one great experience.
That is absolutely not enough information to buy the stock. Not even close.
Oh man, I've definitely fallen into that trap. Loved the brand, bought the stock, watched it tank. It's embarrassing how common it is.
It really is. So many people lose money because they jump in on a product they like or maybe one they barely understand just because the price is going up. Momentum chasing.
Lynch even had a name for it, didn't he? Something about
the Charmin syndrome. Buying based on brand familiarity, like recognizing Charmin toilet paper, without doing any real homework on Procter & Gamble, the company behind it.
Right. And look at Zoom Video during the pandemic. Revenue, operating income went through the roof.
Astronomical growth.
Yeah.
2020, 2021, insane numbers. And the stock price skyrocketed.
But how many people buying it actually understood its competitive advantage, its long-term strategy? Or were they just buying because, well, everyone was using Zoom and the stock was hot?
A lot were definitely in that latter group. And then what happened? A 90% drawdown from its peak. Ouch.
It's that Charmin syndrome familiarity blinding you to the actual business reality, mistaking that emotional connection for solid investment research.
So the next step is absolutely crucial. Do your homework.
As Lynch put it, know what you own and know why you own it. Couldn't be clearer.
And that means digging into the fundamentals. You have to research the company's earnings.
Are they growing consistently, sustainably, or was it just a one-off good year?
Check the balance sheet. What are the assets, liabilities? Is there healthy cash flow?
How much debt are they carrying? Is it manageable for their type of business?
What's their actual competitive edge? What stops someone else from doing the same thing?
Do they have clear plans for growth? And is the management team competent? Do they seem aligned with shareholders?
It sounds like a lot, but it's essential. And Lynch broke it down further into 3 key steps before you even think about buying, even if you love the product.
Okay, what are they?
First, that proper analysis we just talked about. The metrics, growth, profit, debt management. Got to check those boxes.
Makes sense. Step 1, fundamentals.
Second, look at geographic expansion. If a business is doing great in your town, that's interesting. But wait, see if it can succeed elsewhere.
The cloning idea. Can they replicate that success?
Exactly. That's how a local taco joint becomes Taco Bell. It proves the model can scale. Lynch learned this the hard way, apparently, with a company called Buildners. Great in Massachusetts, but failed when it expanded too fast outside its home turf.
Okay, so check fundamentals, check scalability. What's the third step?
This one's easy to miss. Make sure the product you love actually matters to the parent company's bottom line.
Oh, right, the Retin-A example.
Perfect example. Johnson & Johnson's Retin-A. News about its anti-aging potential made this stock jump, adding like $1.4 billion in market cap.
Huge jump.
But the actual sales of Retin-A the previous year, only $30 million. For a giant like J&J, that's, well, Lynch called it a nothing burger.
So the market got excited about something tiny relative to the whole company.
Precisely. Lots of great brands we know are just small cogs in huge machines. Your favorite deodorant might be a tiny part of P&G, that toothpaste, a fraction of Halon PLC's revenue. Popularity doesn't always equal profit impact for the parent.
So the takeaway is, treat tips, even from smart people or your own observations, just as leads.
Exactly. A starting point for research. Not a buy signal. Definitely don't blindly follow tips from, WhatsApp groups or your Uncle Bob.
Even if Uncle Bob is rich, he might have 50 duds for every winner he talks about.
You don't want to inherit his mistakes. Do your own homework. Always.
It's so true. And doing that homework helps you weather the storms, right? Because the market is, well, it's noisy.
Oh, it's volatile.
Yeah.
Uncertain. Prices swing wildly sometimes. But Lynch's point was simple. The key to making money in stocks is not to get scared out of them.
Patience and conviction. Easier said than done sometimes, but crucial.
And Warren Buffett has a similar take, doesn't he? He sees the market not as something to listen to for advice, but more like a place to check if anyone's offering a silly price.
Making the market your servant, not your master. I like that.
Yeah. Lynch compared Wall Street sometimes to ancient Greeks arguing about how many teeth a horse has.
Instead of just opening the horse's mouth and counting.
Exactly. Focus on the actual business, the fundamentals, not just the water cooler gossip about which sector is hot this week.
That reminds me of that story Lynch told about market reactions. The Cuban Missile Crisis, literally the brink of nuclear war.
And the market fell, only 3%? It's unbelievable.
But then, just months later, President Kennedy gets involved in steel prices and the market drops 7%.
It just shows. You can't predict how the market will react, even if you could predict the events themselves. Which is why chasing news is often pointless compared to understanding the business.
Which leads nicely into another key Lynch idea, contrarian thinking. But maybe not in the way most people think about it.
Right. The true contrarian, in Lynch's view, isn't just automatically taking the opposite side of whatever's popular, like shorting a super hot stock.
So what do?
They wait. They wait for things to cool down. They look for stocks that nobody cares about anymore, the ones that make Wall Street yawn.
The unloved stocks.
Yeah. Often these have very little institutional interest, maybe low ownership by the big funds, the price is beaten down.
But the underlying business might still be solid.
Or even have incredible products still in high demand. It's just overlooked. Maybe it's too small for the big guys or in an unfashionable industry. but it can lead to steady, sustainable growth the market just isn't pricing in.
Like that example of buying a business with doubling cash flow at a PE of 8.
Exactly. A situation institutional investors might ignore because of market cap rules or whatever, but the value is there, hidden in plain sight if you're willing to look where others aren't.
Finding value where others yawn. Okay, so if you find these potential opportunities, how do you categorize them? Lynch had his famous 6 categories, right? Which seems super useful.
Hugely useful. Because you can't treat every stock the same way. There's no single magic formula. These categories help you understand what to expect from a company, what kind of ride you're signing up for.
It's like a strategic roadmap for your expectations. Okay, let's quickly run through them. What were they?
Okay, first, slow growers. Think large, mature companies, growing just a bit faster than the overall economy, maybe.
Like Ford or Procter & Gamble, big established names.
Exactly. They often pay steady, maybe growing dividends, good for income, probably not for hitting home runs.
Got it. Then stalwarts.
Still large, established companies, but with a bit more growth, maybe 10, 12% earnings growth per year. Think Coca-Cola, Bristol-Myers.
So solid, reliable growth, and they tend to hold up okay in recessions.
Generally, yeah.
Yeah.
They offer good protection, a solid portfolio anchor.
Okay, next, cyclicals.
These are tricky. Businesses whose sales and profits rise and fall with the broader economy. Autos, airlines, steel, chemicals, commodities.
Timing is everything here, right? Buy low in the cycle, sell high.
That's the idea. But it's notoriously hard to do perfectly. Lynch said they're probably the most misunderstood category. Get the timing wrong, and you can get hurt.
Makes sense. Okay, number 4. Lynch's favorite, I think.
Fast growers. Yep, his favorite hunting ground for those Tenbaggers. These are often smaller, aggressive, newer companies growing maybe 20, 25% a year, sometimes more.
Wow, that's where the big potential gains are.
But interestingly, Lynch actually liked finding fast growers in slow-growing industries.
Why is that? Seems counterintuitive.
Because it offered protection. Less competition jumping in if the overall industry isn't sexy. He gave an example of Dino Polska, a Polish grocery chain. It grew like 60% annually, while the whole Polish grocery market grew maybe 6%, dominating a slow niche.
Clever. So with fast growers, the key is not to overpay for that growth.
Right. And don't expect crazy high growth rates to last forever. Be realistic and really understand their competitive position.
Okay, 2 left. Turnarounds.
These are the fallen angels, companies that have been beaten down, maybe close to bankruptcy, putrid businesses, as Lynch might say.
So high risk, high reward.
Potentially. But you absolutely must identify the catalyst, what's going to turn it around. New management, restructuring, and acquisition. Their fate is often less tied to the overall market, which makes them unique.
And finally, asset plays.
These are companies sitting on hidden value, assets that Wall Street has missed or undervalued. Could be land, timber, oil reserves, maybe valuable patents.
And often these assets are listed on the balance sheet at their old original cost, not their current market value.
Exactly. So there's hidden value there. And this is where your local edge, that thing we talked about earlier, can be a huge advantage. You might know about that valuable local real estate the company owns before Wall Street does.
Fascinating. 6 categories, 6 different ways to think about stocks. So putting it all together for long-term success, Lynch was big on 10-baggers, wasn't he?
Oh, yeah. Stocks that can grow tenfold or more.
Yeah.
He believed finding just a few of those in your investing lifetime could make all the difference.
All you need is a few big winners.
Right. And you don't need to be right all the time. He figured if maybe 6 out of 10 stocks in your portfolio are winners, you'll do pretty well, especially if 1 or 2 are those massive 10-baggers.
It connects to that George Soros idea, right? It's not just about being right or wrong.
But how much you make when you're right and how much you lose when you're wrong. The magnitude of your wins often matters more than the frequency. One huge win can offset several small losses.
Okay, so focus on finding potential big winners. Do your homework. What about major mistakes Lynch warned against?
Oh, he had a list. First, steer clear of hot stocks and hot industries. They're often just speculative bets without solid fundamentals underneath.
Like that home shopping network example, shot up from $3 to $47.
And crashed right back down to $3. Classic speculative bubble.
What else? Diversification.
Yeah, his term for companies diversifying badly, expanding into totally unrelated areas where they have no expertise just for the sake of growth.
Like Gillette trying to make digital watches.
Exactly. It led to big losses. Successful diversification needs synergy, some kind of logical connection. Otherwise, it just distracts management and wastes resources.
Okay, what else should we avoid?
Beware of exciting names or buzzwords. A flashy name doesn't mean a good company. Think about the dot-com bubble names.
Yeah, Doom or Miss International or whatever. Focus on fundamentals, not the ticker symbol.
Right. And watch out for overconcentration risks. Is the company too reliant on one big customer or one key supplier?
Like early Nike, depending on just one supplier. Or Micron losing Huawei as a huge customer due to politics.
Those kinds of dependencies make a company really vulnerable if something goes wrong with that single relationship. Diversify your customer base, your suppliers. It's important for resilience.
And the big one, trying to time the market.
Forget about it, basically. Lynch said investors usually get pessimistic right at the bottom and optimistic right at the top, precisely the wrong times.
Predicting short-term swings is futile. Just focus on the long term.
And don't blindly follow those arbitrary rules you sometimes hear, like always sell when you double your money, or always cut your losses at 10%.
Why not? They sound disciplined.
Because they're generic. Selling just because you doubled your money might mean getting out of a potential 10-bagger way too early. And a 10% drop might just be market noise for a solid company you should actually be buying more of. The rules need to fit the stock category and the story.
The story. So it's not just buy and hold forever either. You need to keep checking in.
Absolutely. Continual review is key. You need to periodically recheck the company's story. Are the fundamentals still strong? Are earnings growing? How's their market position? Read the reports.
And understand where a growth company is in its life cycle, right? Startup, rapid expansion, maturity.
Exactly. Startup is riskiest. Rapid expansion is often the sweet spot, where the most money is made safely. Mature saturation phase, that's tougher. The company needs to innovate or find new growth avenues, otherwise it risks becoming a slow grower or worse. Knowing the phase helps you manage expectations.
And what about diversification? We talked about diversification for companies, but what about for our portfolios?
Lynch had strong views here too. He said, foolish diversity is the hobgoblin of small investors.
Meaning?
Don't just buy a bunch of stocks you know nothing about just to feel diversified. Own as many stocks as you actually have an edge in, meaning you understand the business and have done the homework.
So quality over quantity.
Definitely. For a small investor, maybe 3 to 10 stocks you really know well can be perfectly fine, even better than owning 50 you barely understand.
And your personal situation matters too, presumably. Age, risk tolerance.
Of course. If you're younger with decades of earning potential ahead, you can probably afford to take more chances on those fast growers or even turnarounds. If you're closer to retirement, you might lean more towards stalwarts or slow growers that pay reliable dividends.
Makes sense. Okay, one last big point. Market crashes. Scary times.
Lynch saw them differently. Those big drops, burbs, hiccups, free falls. He saw them as fantastic opportunities.
Opportunities when everyone else is panicking.
Especially then. Opportunities to buy shares in great, solid companies at bargain prices you might not see again for years. If you've done your homework and have conviction in the business, a market crash is a sale, not a disaster.
If you can summon the courage to buy when things look bleakest,
that's often when the best long-term returns are made. It reminds me of that study you mentioned, looking at Lynch's strategy in Indonesia.
Right, the emerging market application. It had mixed results overall, but notably, it tended to outperform during the tough times, bearish markets, sideways markets.
Which kind of reinforces the point. His focus on fundamentals provides a certain resilience. The study also noted that high volatility in some of those stocks wasn't necessarily bad risk. It actually reflected rapid growth sometimes. So again, deep analysis matters more than just looking at price swings, especially in maybe less efficient markets.
So wrapping this all up, we've covered a lot. From finding your edge in everyday life to the absolute necessity of homework.
Ignoring the market noise, thinking like a contrarian, understanding those stock categories.
Avoiding common mistakes, focusing on big winners, and even seeing market crashes as potential opportunities.
Fundamentally, Lynch's wisdom isn't about fancy algorithms or secret insider info. It's really about disciplined common sense and deeply understanding the businesses you invest in.
It really is an empowering framework, isn't it? Makes you feel like you can do this.
Absolutely. So what's the final thought we want to leave people mulling over? Something provocative.
Okay, how about this? Straight from Lynch. A stock does not know that you own it.
Ooh, that's a good one. Simple, but deep.
Think about it. Your emotions, your hopes for the stock price, your fears when it drops. The underlying business doesn't care. It has no idea you're even invested.
So the question to ask yourself is, How much of your investing strategy, your decisions to buy or sell, is really about the company's fundamentals and its long-term story?
And how much is just about your own emotional reaction to the price wiggling around on your screen, your hopes, your fears?
It's a really crucial distinction to make if you want to invest rationally, like Lynch advocated. Something definitely worth thinking about.